Hello and welcome to Upstack America's Oracle EBS Financials Functional Training. My name is Bob and I'm the lead senior consultant for Upstack America. And with me today I have Victor, who is also a senior consultant. And today we are handling lesson 1 of the fixed assets module. And Victor, please walk us through.
Thank you, Bob, for the introduction. I welcome everybody to this lesson in our Financials Functional Training series. As Bob said, this is lesson 1 of Oracle Fixed Asset Module. So this is going to be an introduction lesson talking about a few things concerning FA. We are going to see what the purpose of FA is, what it does as a module, and its relation to the other modules. And the other thing that we are going to talk about is an introduction to the types of assets that we can have, all right, so that we have an understanding of what we are talking about when we are discussing the module and the configurations. And we're also going to talk a bit about the concept of depreciation, so you can understand what depreciation is before we now start jumping into the configurations. So let's start talk about the purpose of the FA module. And we can say that the purpose of a FA module is split into two main areas. One is asset management, and the other one is to generate depreciation entries. Okay, so we could say that those are the main overall purposes of FA module. Under asset management, of course, you have various things you can do. Asset addition, when new assets are acquired, okay, and you want to start tracking them or generating entries for them, then as that's asset addition. Then you have retirements. Assets are sometimes they outlive their use, okay, or they get stolen or they get lost. So you can you do what you call retiring them. Basically, you say they're not in use anymore. We have other things such as revaluation. Maybe the value of an asset changes, then FA module will allow you to do this. And reclassification, we have different classifications of assets in terms of, let's say, categories and all that. We are going to talk about that as we delve in deeper into the module. But these are basically some of the things that you can class under asset management. We also have transfers and tracking, and we are going to talk about them or look at them in depth as we continue with our lesson. The other main function is generating depreciation entries, okay, and we are going to see what depreciation is, but we could say actually this is the main function of FA module, as far as you can go maybe a period without having to do any of this asset management functions or tasks that you can do here, the additions, the revaluations, the retirement. But if you do have assets that you're managing, you have to you have to generate depreciation entries at the end of every period. So this is something that you have to do. All right, this one depends on whether there are assets that require this stuff to be done for them. All right, so that is a small overview on what the purpose of the fixed assets module is. Now, the other thing that I want to clarify is, well, we were talking about the other subledger modules. The only one, of course, we've talked about in depth is AP. But when we are talking about other modules such as AP, AR, cash management, CE, we usually talk about how they help an enterprise or the company that's using these applications to manage its relationships with external entities. For example, AP manages the relation between the company and vendors or suppliers, all right, which are external parties. AR manages a company's relationship with its customers. Cash management, you can say it helps managing relationship with the bank. However, fixed assets is used to manage the assets of the entity. So in our makeup setup, we have what? Maskani. So if Maskani is using FA module, it's using it to manage the assets that it owns. So if it owns buildings, if it owns vehicles, if it owns undeveloped land or something like that, or the machinery that it uses for the purposes of providing goods and services to its customers. FA helps to manage the company's own internal assets. Okay. So unlike the other subledger modules which manage relationships with external parties, this is FA is different in that way. So the next thing I want us to talk about is the types of assets that you will be dealing with in FA module. And these are the three types of assets: capitalized assets, construction in process assets, and expensed assets. Okay. So let's see what each one of them means. And we are also going to maybe give examples. So capitalized assets, maybe let's start with the examples. When you talk about capitalized assets, you can think of things such as huge machinery or buildings, okay? Maybe computers, computing devices that are used in performing business activities, okay? But when we focus on the term capitalized itself, we are talking about an asset which the company has decided that it will write off the cost of that asset over the life, over its useful lifetime, okay? So when you think about something like a vehicle that maybe Maskani is using to conduct its business, if Maskani bought that vehicle for $10,000, and we are going to understand this more when we're talking about depreciation. So if Maskani bought that vehicle for $10,000, they can either decide to expense it, okay, or they can decide to capitalize it. Of course, there are rules which govern, let's say, what assets are going to be capitalized and which ones are going to be expensed. But if Maskani decides to capitalize the cost of this asset, which is the vehicle, it means that if they bought it for $10,000, they're not going to show that they spent $10,000 in a particular period to buy this vehicle. Rather, because they're going to be using this vehicle for a long period of time, let's say like 6 years before they sell it, then they will say they are going to divide that $10,000 among those 6 years, and every period, or you can say every year, they are going to deduct a cost or a portion of that $10,000 that they purchased that vehicle for, all right, and spread it over the 6 years that they are going to be using that vehicle, all right. So that is what we mean by capitalization. And so when we talk about capitalized assets, we're usually talking about assets that have a typically long useful lifetime, more than 1 year, or we can say even more than one period, okay? And so what happens is that these assets are in the system, and we are generating depreciation entries for them, okay? When we talk about construction in process, you can have a scenario whereby a company is building its own assets that it's going to use for future income generation activities. So maybe a company, Maskani, is building a new warehouse, okay? Or Maskani is building a new machine that they're going to be using for construction. Instead of purchasing that machine, they just decided to build it themselves. They bought it. They bought the parts and they're putting them together, okay? So that is an example of an asset that could be construction in process. And usually these construction in process assets will then become capitalized assets, which you will be generating depreciation expenses for. So that's construction in process, and we are going to be abbreviating this actually as CIP. Okay, so when we say CIP, this is what we mean. Let's talk about expensed assets. So the way to see these assets is in comparison with capitalized assets. Expensed assets, you can say that they don't promise any future economic benefit. It's just those things that you have to purchase or the sacrifice or the cost you have to incur for the purposes of providing services. Okay, so something that you can use in a very short time, and you can call it maybe an operating expense. So let's say if you have a device that you buy that can be used within one period, okay? So maybe some very cheap printers, and usually by the end of the period, they are all used up or broken down and you have to buy another one. So these are just examples of expensed assets. The difference is that they have a much shorter useful lifetime, and of course they are much cheaper. So it doesn't make sense to expense the cost of a long period. It doesn't make sense to capitalize them, okay? So you cannot say, for example, you're going to capitalize a pen just because it's something that you use for the business, okay? That's just an example. Because one, it's very cheap, okay? And it doesn't provide any future economic benefit in terms of like income generation or something like that. So just a quick overview, capitalized assets are already in use and they are being depreciated, okay? So when something, when an asset is a capitalized asset, it's already in use and we are generating depreciation entries for it. Construction in process, we have said they are currently being built, all right? And finally, they are going to end up as capitalized assets, okay? And then we have expensed assets, which you can, they don't depreciate. You don't depreciate them because you incur the whole cost in the period when they were purchased or acquired, all right, then they're very cheap. So those are the three types of assets. But again, various companies or maybe regulators will have different rules of whether to expense or to capitalize assets. So let's talk about how these assets are added to our FA module. So assets can come from payables if they are expensed or capitalized assets. Okay, so these are assets which you can purchase. For example, if you purchase a vehicle from a dealership, you get an invoice uh, from them, right? And so you can add that asset to FA from payables because it's something that you've purchased and you have an invoice for, and all that process of the procure to pay. And the same thing for expensed assets. They can come from payables module. You can also add construction in process assets from projects. So this is another module or another application, Oracle owned application. And so it helps to track projects. So if one of your assets, let's say the building that you are constructing or the machine that you're putting together for future use, is being tracked using Oracle projects, then once it's finished, it can be added to your FA module, your FA books from Oracle projects, okay? And then, of course, you can do manual addition, okay? You can do manual addition of construction in process assets, okay? If you're not using Oracle projects, so you can add these assets manually to your books. However, these ones, since you are purchasing them, then it becomes easier to just move them, to take them from payables and to FA. Of course, what comes out of the fixed asset modules is the depreciation entries that you run for these assets, and those ones go to your GL module, just like the other modules and their transaction information, okay? So when you generate depreciation entries, then they are sent to FA. Accounting is created for them and they are sent to GL, sorry. So far so good. We have talked about types of assets, the purpose of FA, the types of assets, and how they are added to FA module. So now we are going to talk about depreciation, just to have a clearer understanding before we delve into the actual transactions and configurations in the module. So let's try to understand the concept of depreciation. Maybe some of you may already know what it is, or you've heard what depreciation is. But depreciation, it allows a company or an organization to write off the cost of an asset of to write off the cost of an asset. This is supposed to be off with a double F. It's of its lifetime, okay? So I've already explained that concept using the example of a vehicle, all right, that Maskani purchases for the purposes of carrying out business. So instead of in its financial statements, instead of saying of incurring the cost of that vehicle for in that specific period that they acquired that vehicle, since this vehicle is going to be useful over a long period of time, they can spread over the cost of that vehicle over the useful lifetime. Okay, so what they are doing is basically they are saying that every period we are incurring an expense. That expense is a small portion of what we paid, the total value that we paid for this vehicle. Okay, so instead of incurring the whole expense in that period when the vehicle was acquired, they incur the expense in small portions over the period of the useful lifetime of that particular asset. So those expenses, those small expenses that they incur every period, are what are called the depreciation expenses. Basically, it's saying that we are using this asset and its value is reducing. So that is like it's an asset to us, but its value is reducing. So that's a cost to us. Okay. So they're reducing the value of that particular asset every period. And of course, that will have implications, all right, on financial statements of the company, what they look like. We're going to talk about that too. So this is just an example that I have shown here. So let's say this is Maskani, and this is just a small representation of their company figures. So the total revenue that they generate in January is 10,000, and they have total constant expenses of 10,000, giving them an income of 9,000. All right. However, in February, Maskani bought a machine. You can say maybe it's a vehicle or another type of asset for $5,000. All right. So in this case, they can decide to say, okay, this is an expense we incurred, $5,000. We are going to add it to our expenses, make our expenses 6,000. So the net income for that period will be 4,000. And then when we go back to March, they go back to the normal. So whereby the revenue is 10,000 and the expenses are 1,000. So in this kind of scenario, what Maskani has decided to do is that they have decided to expense this particular item. So they have decided to incur this hit of 5,000 in one period and then continue with the other period as normal. So if you think about it in this sense, what might be the effect on the maybe financial statements of this company? It might show that in February they had very few, very low profits. Okay, even though they're using this machine, let's say it's a vehicle, they're going to be using this machine for the next 5 years. You can see here, useful life is 5 years, and in those 5 years, we are assuming that this machine is generating some income from them. It's taking place in some activities that generates some income. All right. So in this case, they can decide to treat it as an expense, and this is what their financial statements in quotes will look like: a very low profitability for this particular period. Or they can decide to go the capitalization route, okay, and say, look, we have purchased this vehicle, all right, it cost us $5,000. It's going to be useful for 5 years, all right. So what we are going to do, we are going to use this depreciation method called straight line depreciation, whereby we are going to deduct an equal amount over this 5,000 over the period of 5 years. So 1,000 every year, and then 1,000 divided by 12, assuming they're using this monthly period, you get around $83. Okay, so every period they are going to be deducting $83 as a depreciation expense. Okay, and now this is what their figures will look like. They acquire the vehicle in February, so the first depreciation expense you can say is generated in February, and it's $83. So their expenses will go up only by $83, and their net income will go down just by $83. And this, assuming this is the only asset that they have or they acquire for the next 5 years, and their revenues and expenses remain the same, then their net income will be stable at 89.17 until this vehicle is fully depreciated. Okay, and straight away you can see one of the effects of capitalization versus expensing in terms of the variability of things like profits on your financial statements. So if you decide to expense a very huge cost, then it will seem as if your company's profits go up and down very often, or they vary a lot. Whereby when you choose to capitalize, you can spread out this cost over a long period of time. Okay, but actually the main purpose of this slide was to explain to you the concept of depreciation, and just to show you that it is basically incurring a cost over the useful period of over the useful lifetime of a particular asset, instead of incurring that cost in a single period when that cost was actually. That's not a very deep explanation, but it should be enough for you to understand the concept of depreciation, so that now when we start talking about accumulated depreciation and depreciation expenses in our other lessons, you will not be lost, and you'll have a good understanding of what we are talking about. Anyway, that's it for this introduction. We are going to talk more about depreciation when we do the accounting. We are going to talk about various types of depreciation methods. But for now, we can end this session there. That's of course, unless Bob, you have something to add.
All right, thank you, Victor.